trading. Chart pattern analysis isn't just a skill, it's the heartbeat of successful futures trading. Think of it as the language of the market, where each pattern tells a story, revealing the hidden forces driving price movements. Today, we're about to unravel these stories, diving deep into the art of chart pattern analysis, specifically tailored for the dynamic world of futures trading. Imagine recognizing a pattern that signals an impending price breakout. It's like being let in on a market secret before it becomes common knowledge. Patterns like head and shoulders, double tops and bottoms, or even the elusive wedge formation are more than just shapes on a screen. They're whispers from the market, guiding you on when to enter or exit a trade. But recognizing these patterns is only part of the game. Understanding how to act on them with precision is where the real edge lies. This is where order types come into play. Tools like stop loss and limit orders aren't just safety nets. They are strategic moves that can turn potential losses into gains. A well-placed stop-loss order can protect your capital by automatically closing a trade at a predetermined level, while a limit order ensures you lock in profits when the market hits your desired price. Think about how these tools work together with chart patterns. Spotting a double bottom might suggest a potential rise in price, but without the right order type in place, that insight could go to waste. Combining pattern analysis with strategic order placement is like setting the perfect trap for the market. It's all about timing and precision. As you sharpen your skills, remember that mastering chart patterns and order types isn't just about knowing what's happening now. It's about predicting what could happen next and positioning yourself to take full advantage. It's about staying one step ahead, making informed decisions, and managing risk like a pro. Trading isn't just about the numbers. It's about understanding the story behind those numbers and using that knowledge to your advantage. As we explore these concepts, you'll find that the market's movements start to make more sense, and your trading decisions become more confident, more strategic, and ultimately more successful. Let's start by diving into the head and shoulders pattern, one of the most reliable indicators of trend reversals in the market. Imagine a stock price climbing to a significant peak. The highest point it reaches is what we call the head. On either side of this peak, you'll see two slightly lower peaks, forming what we refer to as the shoulders. Together, these three peaks create the distinctive shape that gives the pattern its name. Now, here's where it gets interesting. Below these peaks lies the neckline, a level of support that the price has tested multiple times. When the price finally breaks through this neckline, it's like the market is telling you something crucial. A reversal is likely underway. What was once an uptrend now has the potential to shift into a downtrend. This pattern isn't just about recognizing shapes, it's about understanding the psychology of the market. The head represents the final push of the bulls, while the shoulders show their waning strength. When the neckline breaks, it's the bears taking control, signaling that the upward momentum has exhausted itself. Being able to spot the head and shoulders pattern early can give you a significant advantage, allowing you to anticipate a trend reversal before it fully plays out. It's like having a roadmap for the market's next move, helping you make informed decisions on when to enter or exit your trades. Now, let's turn our attention to the double tops and bottoms, two patterns that are not only easy to spot, but also powerful signals of potential trend reversals. These patterns are like the market's way of telling you it might be time for a change in direction. Picture a double top. This pattern emerges after a sustained uptrend where the price reaches a high point, pulls back, and then makes another attempt to reach that same high. However, Instead of breaking through to new highs, it stalls and starts to fall. It's like the market trying twice to break a ceiling but failing both times. This inability to push higher often signals that the upward momentum is weakening, and a reversal to the downside could be on the horizon. On the flip side, we have the double bottom. This pattern appears after a downtrend where the price sinks to a low, rebounds, and then drops to test that same low again. When the price doesn't go lower the second time and instead starts to rise, it suggests that the downtrend is losing steam and an upward reversal might be in the making. Both of these patterns are valuable because they give you a clear visual cue that the current trend may be coming to an end. Spotting a double top or double bottom in real time allows you to prepare for the possibility of a reversal, helping you to make more strategic decisions about your trading positions. Whether you're looking to lock in profits from a previous trend or position yourself to catch the next one, these patterns are essential tools in your trading toolkit. Triangles are another key pattern you'll want to have in your arsenal, as they're powerful indicators of consolidation and potential breakouts. Each type of triangle ascending, descending, and symmetrical tells a different story about what might be coming next in the market. First, let's talk about the ascending triangle. This pattern features a flat top where the price repeatedly hits a resistance level, while the bottom rises as buyers step in at higher prices each time. It's a sign of building pressure as the market is gradually moving higher, pushing against that resistance. When the price finally breaks through the flat top, it often signals a strong upward breakout driven by the pent-up demand. Now consider the descending triangle, which is essentially the opposite. Here, you'll see a flat bottom where the price finds support, but the top is falling, with each rally running out of steam at a lower level than before. This pattern indicates that sellers are gaining control, and when the price breaks below the flat bottom, it often leads to a significant downward breakout. Then there's the symmetrical triangle, where neither the buyers nor the sellers are in full control. This pattern is characterized by converging trend lines, with both the highs and lows getting closer together. The market is coiling up like a spring, and when it finally breaks out of the triangle, it can move strongly in either direction. The key with symmetrical triangles is to be ready for a breakout, but remain flexible, as the direction can go either way. All three triangle patterns are about recognizing moments of consolidation, periods where the market is taking a breather before making its next big move. By understanding these patterns, you're better equipped to anticipate that move, positioning yourself to capitalize on the breakout, whether it's up, down, or in either direction. Flags and pennants are short-term continuation patterns that often signal a brief pause before the prevailing trend resumes its course. These patterns might be small, but they pack a lot of information about the market's next move. Let's start with the flag. Imagine a strong price movement, a sharp rally or decline, and then the market takes a breather. The price action forms a small rectangle, slightly sloping against the prevailing trend thighs is the flag. It's like the market catching its breath, gathering strength before continuing in the same direction. Whether the flag is pointing slightly upward in a downtrend or downward in an uptrend, it usually suggests that once the consolidation ends, the original trend is likely to resume with renewed momentum. Now consider the pennant. After a significant price move, instead of forming a rectangle, the market tightens into a small, symmetrical triangle. This pattern resembles a pennant waving in the wind, with the price action converging before it breaks out. Like the flag, the pennant indicates that the market is in a brief consolidation phase, preparing for the next leg of the trend. Both flags and pennants are like pit stops in a race. The market takes a quick pause, but the momentum hasn't disappeared. These patterns are your cue that the market is likely to continue in the direction it was heading before, making them essential signals for traders looking to ride the trend to its fullest. Recognizing these patterns early allows you to stay in the trade, knowing that this pause is temporary and the trend is likely about to continue. Now, let's explore how to identify these patterns and effectively apply them in your trading. One of the most practical tools at your disposal is the trend line. Drawing trend lines not only helps you identify the overall market direction, but also makes it easier to spot key patterns that can inform your trading decisions. In an uptrend, you want to focus on the lows of the price action. By drawing a line connecting these lows, you're essentially tracing the path of support level where the price tends to find buyers and bounce back up. This trend line can act as a guide, showing you the general direction of the market and helping you to spot patterns like ascending triangles or flags that might form along the way. When the price respects this trend line, it's often a sign that the uptrend is still intact, and you can use this information to make confident trading decisions. In a downtrend, the approach is reversed. Here, you'll connect the highs of the price action. This trend line acts as a level of resistance, the point where the price struggles to break through as sellers dominate. By tracing this line, you're able to see the market's downward trajectory more clearly and identify patterns like descending triangles or pennants that suggest the trend might continue. When the price consistently meets resistance at this trend line, it reinforces the strength of the downtrend. These trend lines aren't just visual eights-tier tools that can help you anticipate the market's next move. By combining trendline analysis with the patterns we've discussed, you can gain a clearer picture of what the market is telling you. Whether it's spotting a potential breakout or identifying a continuation of the current trend, these techniques equip you with the insights needed to trade with greater precision and confidence. Support and resistance levels are fundamental concepts in trading, acting as the building blocks for understanding market behavior. Think of support as the floor beneath the pricier level where a stock tends to stop falling and often starts to rise again. It's where buying interest is strong enough to halt the decline, creating a cushion that the price bounces off from. Recognizing where this support lies is crucial, as it can guide you on when to enter a trade, anticipating a potential upward movement. On the other hand, resistance is like the ceiling above the pricier level, where a stock tends to stop rising and often begins to fall. It's the point where selling pressure outweighs buying interest, preventing the price from climbing further. Identifying resistance helps you understand where the market might struggle to move higher, signaling a potential reversal or a place to consider taking profits. These levels don't just appear randomly. They're often formed by previous highs and lows, or psychological price points where traders have consistently acted in the past. By identifying and marking these levels on your charts, you gain a clearer picture of the market's boundaries. This insight allows you to make more informed decisions, whether you're looking to buy near support, sell near resistance, or prepare for a breakout if these levels are breached. Support and resistance are like the guardrails of the market. They help you navigate the ups and downs, providing key reference points for your trading strategy. When you combine these levels with chart patterns and trend lines, you create a robust framework for analyzing price action and making strategic trading decisions. Volume analysis is an essential tool that adds another layer of insight to your trading decisions. When you spot a pattern forming on the chart, volume can be the key to understanding the strength of that pattern. It's like the heartbeat of the market, giving you clues about the conviction behind a price move. Imagine you see a classic pattern like a head and shoulders, double top, or triangle starting to take shape. The price action alone might look promising, but it's the volume that can confirm whether this pattern is likely to play out as expected. High volume during the formation of a pattern signals strong participation from traders, suggesting that the pattern is backed by significant buying or selling pressure. This adds weight to the signal, increasing the likelihood that the pattern will lead to a meaningful breakout or reversal. On the flip side, if a pattern forms on low volume, it might be a weaker signal. Low volume indicates that fewer traders are involved, which could mean there's less conviction behind the move. This lack of enthusiasm can result in a false breakout or a pattern that doesn't fully materialize. By paying close attention to volume, you're not just taking the pattern at face value, you're looking under the hood to see what's really driving the market. This helps you filter out weaker signals and focus on the setups with the most potential. Volume analysis, combined with pattern recognition and trend lines, equips you with a more comprehensive understanding of market dynamics, enabling you to trade with greater confidence and precision. Combining chart patterns with the right order types is like putting the final touches on a well-crafted trading strategy. One of the most effective tools in this arsenal is the stop-loss market order. This order type acts as a safety net, automatically selling your stock when it reaches a predetermined price, thereby minimizing potential losses. Let's put this into context with a practical example. Imagine you've identified a double top pattern, a strong indicator that a reversal from an uptrend might be on the horizon. You've already seen the price peak twice and start to decline. To protect yourself from a significant downturn, you could set a stop-loss market order just below the recent low that formed between the two peaks. By placing your stop-loss at this level, you're essentially saying, if the price drops below this point, I want out. This approach limits your downside risk if the pattern plays out as expected and the price continues to fall. Instead of waiting and hoping that the market will turn around, the stop-loss order ensures that your trade is automatically exited, preserving your capital. The beauty of the stop-loss market order lies in its ability to remove emotion from your trading decisions. Once the order is set, you don't have to worry about making a quick decision in the heat of the moment. It's a proactive way to manage risk, allowing you to focus on identifying new opportunities while ensuring that a single trade doesn't derail your overall strategy. Incorporating stop-loss market orders into your trading, especially when paired with patterns like the double top, enhances your ability to manage risk and protect your investments. It's a critical step in turning pattern recognition into a comprehensive trading plan that not only seeks profits but also safeguards against losses. Let's walk through a simple step-by-step guide on setting a stop-loss order in RTrader Pro. This process will help you manage your risks effectively, especially when trading volatile patterns. First, start by selecting the stock or futures contract you're trading within the RTrader Pro platform. Make sure you've done your analysis and identified the key level where you want to place your stop loss. Next, navigate to the order entry section and choose the stop loss order option. This is where you'll specify the price at which your position will automatically be sold if the market moves against you. Now enter your trigger price. This is the price level you've determined through your analysis, perhaps just below a recent low in a double top pattern or beneath a support line. Setting this trigger ensures that if the market hits this level, your stop-loss order will be activated, selling your position to limit further losses. Finally, review your order details to make sure everything is set up correctly. Once you're satisfied, confirm the order. Your stop loss is now in place, providing you with a safety net as you trade. This setup is crucial when dealing with volatile patterns, as it allows you to manage your risks without needing to monitor the market constantly. By having a stop loss order in place, you can trade with more confidence, knowing that your downside is protected. Now let's dive into market limit and stop limit orders, two powerful tools that can give you greater control over your trades. A market limit order allows you to execute a trade at a specific price or better, ensuring that you achieve the desired entry or exit price. Unlike a market order, which executes immediately at the current market price, a market limit order only fills if the price reaches the level you've set or better. This is particularly useful when you have a clear target in mind for buying or selling. For instance, imagine a stock is currently trading at $50, but you believe it would be a better deal if you could buy it at $49. In this case, you would set a market limit order to buy the stock at $49. If the market price falls to $49 or below, your order will be executed, ensuring that you enter the trade at the price you've determined to be optimal. If the price doesn't reach your limit, the order won't execute, which means you won't have to overpay or settle for a less favorable price. This type of order is particularly useful when you're looking to buy or sell at a specific level and are willing to wait for the market to reach your price. It provides the advantage of price control, ensuring you don't enter a trade at a less advantageous price during volatile market conditions. Using market limit orders helps you execute trades on your terms, giving you more precision in your trading strategy. This can be especially effective when combined with pattern recognition, allowing you to set your entry or exit points based on the levels you've identified in your analysis. Stop limit orders are a versatile tool that combines the features of stop orders and limit orders, giving you more control over the execution of your trades. They work by triggering a trade at a specific price, but only within a set range, which can be crucial during volatile market periods. Here's how it works. Imagine you hold a stock currently trading at $50, and you want to protect yourself from potential losses if the price starts to drop. You decide that if the stock falls to $48, you want to sell. However, you don't want to sell it for any less than $48, so you set a stop limit order. With a stop limit order, you would set the stop price at $48, meaning the order is triggered if the stock reaches this level. Once the stop price is hit, the order then becomes a limit order with a specific price range. Let's say you set your limit at $48. This ensures that your stock will only be sold at $48 or better, but not below that price. This order type is particularly useful for controlling slippage, which can occur during volatile periods when prices can move quickly and unpredictably. Slippage is the difference between the expected price of a trade and the actual price at which the trade is executed. By using a stop limit order, you're ensuring that your trade will only execute within the price range you've specified, giving you more precise control over your exits. Stop limit orders are especially beneficial when you want to safeguard against sharp price movements while still maintaining some control over the execution price. They allow you to protect your position without the risk of selling at a much lower price during sudden market fluctuations. Here are some practical tips to enhance your trading strategy using chart patterns. First, when setting stop-loss levels, it's crucial to base them on the chart patterns you've identified. Placing your stop-loss just below key support levels can help you avoid being prematurely stopped out of a trade during normal market fluctuations. For example, if you've identified a double bottom pattern, consider placing your stop loss just below the lowest point of the pattern. This way, you're protecting yourself from a potential downturn while giving your trade enough room to develop. Next, use market limit orders to ensure you buy or sell at the most favorable prices. When you spot a pattern signaling a potential entry point, such as a breakout from an ascending triangle, setting a market limit order allows you to specify the exact price at which you're willing to enter the trade. This approach ensures you don't overpay in a fast-moving market, helping you maintain control over your trade entries. Combining stop limit orders with identified patterns can further refine your trading strategy. For instance, if a stock is forming a head and shoulders pattern and you anticipate a downward move, setting a stop limit order allows you to specify the price range within which you're willing to sell. This not only protects you from excessive slippage during volatile periods, but also ensures your trade executes within a controlled price range, enhancing the accuracy of your strategy. Lastly, take the time to customize your chart layouts to highlight the most relevant data and patterns for your trading style. Whether you focus on specific time frames, indicators, or types of patterns, having a personalized chart setup can make it easier to spot opportunities and act on them quickly. Tailoring your charts to your needs helps you stay organized and focused, ultimately improving your ability to make informed trading decisions. By integrating these practical tips into your routine, you can develop a more disciplined and strategic approach to trading, leveraging chart patterns effectively to achieve better outcomes. Let's dive into the tools and platforms that can enhance your chart pattern analysis, starting with RTrader Pro. This platform is designed to offer a comprehensive set of advanced charting tools and real-time data, making it a powerful ally in your trading arsenal. When it comes to setting a stop loss in RTrader Pro, the process is straightforward. Begin by selecting the stock or contract you're trading. From there, navigate to the order entry options and choose stop loss. Enter the specific price at which you want the stop loss to be triggered. This ensures that your position will automatically be sold if the market reaches your predefined level, helping to minimize potential losses. For market limit orders, the steps are equally simple. Once you've identified the price at which you're willing to buy or sell, select Limit Order from the platform's order options. Input your desired price, ensuring that your trade will only execute at that price or better. After reviewing the details, go ahead and execute the order. This type of order is particularly useful when you want to maintain control over the entry or exit price, avoiding any surprises during volatile market conditions. Setting up stop limit orders in RTrader Pro combines the best of both stop and limit orders, giving you more precise control over your trades. Start by choosing stop limit from the order type options. You'll then need to enter both the trigger price where the stop is activated and the limit price, the minimum price at which you're willing to sell or buy. Once these details are set, confirm the order. This setup ensures that your trade will only execute within the specific price range you've determined, helping to manage slippage and control the execution price, especially during periods of high market volatility. Using these tools in RTrader Pro allows you to implement your trading strategy with greater precision and confidence. The platform's advanced features, combined with your understanding of chart patterns, provide a robust framework for making informed and strategic trading decisions. As we wrap up, let's review some final tips and best practices. Always validate patterns with volume and use multiple indicators for confirmation. Incorporate these tips into your trading to enhance decision-making and risk management. Thank you for joining us today. Keep learning, keep trading, and see you next